Welcome to Dividend Learning Channel. In this video, two stocks from the energy sector, Exxon Mobil and Chevron Corporation, go head-to-head as they try to find a way into my portfolio. I currently have no stocks from the energy sector in my portfolio, so watch until the end to see which one I will be buying. Since early October, oil demand and prices have been decreasing, and this has had a negative effect on both Exxon and Chevron as share prices down by 17% and 13% respectively. Share price of Exxon is $100.90 while Chevron is trading at $149.35. Both stocks have a market cap above $30 billion and are leading companies in the oil and gas sector. Starting with the profit and loss, the first metric we are looking at is the ability of the companies to grow their income on a consistent basis. 5-year average revenue growth of 3 to 5% is comfortably exceeded by both companies. Chevron has a higher revenue growth, but Exxon has a higher EPS growth rate over the last 5 years, returning more value to shareholders. EPS growth for both companies is impressive, but this is due to 2022 being the best year for the industry since 2015. Both companies have an operating margin below 15% we want to see, but they are not far away from it either. Return on investment is a very popular profitability metric used to evaluate how well an investment has performed. Both oil and gas giants' return on investment is below the 7% we are looking for a 5-year period average. Exxon is very close to the 7%, with 6.61% return on investment, while Chevron figure is lower at 5.83%. Before moving to the balance sheet, leave a comment below in case you have any questions. Cash and cash equivalents of Exxon have increased significantly in September 2022 and have since then increased by $2 billion through September 2023. At the same time, current and long-term debt decrease was in excess of $5 billion. On the contrary, cash and cash equivalents of Chevron have declined by $7 billion over the same period. But the good thing is that short and long-term debt decreased by nearly $6 billion. Cash and cash equivalents of Exxon are $32 billion, which roughly covers 80% of both short and long-term debt. On the contrary, Chevron has $5.8 billion in cash and cash equivalents that translates to 27% of debt. Debt-to-equity ratio is very low for both companies, and there is no real difference between the two. Chevron decreased its shares by 2%, while corresponding decrease for Exxon was nearly 6%. Share buyback is always a good sign for companies, but from the graph it is evident that both companies do not decrease their shares consistently, but only when times are good. In difficult times, both companies have increased their share capital. Our intentions are good towards both stocks, so we are going to give them a pass rate for this metric. Time to look at the cash flow of both companies and their ability to generate cash. Q3 free cash flow for Exxon has decreased 44% compared to September 2022. Keep in mind that September 2022 was the highest free cash flow generated by the company in more than 10 years. $11 billion free cash flow is the fourth highest amount generated in the last 10 years. Chevron generates half the free cash flow of Exxon, and decrease from September 2022 is 60%. Free cash flow dividend payout ratio is an important metric as it shows if the companies generate enough cash to pay their dividends. For the quarter ended September 30, 2023, Exxon and Chevron had a free cash flow dividend payout ratio of 40% and 58% respectively. Chevron's rate is higher than that of Exxon, but still has a decent enough margin to pay dividends. Overall, free cash flow and free cash flow dividend payout ratio is looking healthy for both companies. Dividend yield for Chevron is 4.4% and is superior to the dividend yield of Exxon, which is a respectable 3.77%. Both companies offer attracting yields which are well above the S&P 500 average yield of 1.62%. Along with a good yield, both companies have a payout ratio below 50%, signaling that dividend cuts are not expected. Where Chevron stands out compared to Exxon is the dividend growth rate for the last 5 years. Chevron growth rate is 4.86, while that of Exxon is 1.91%. Despite Chevron being superior, both companies have a growth rate lower than 7%, which is the magic number we are looking for. Dividend streak for both companies are 33 and 32 years respectively. Both companies are dividend aristocrats, meaning that they have raised annual dividends for more than 25 consecutive years. Dividend safety score is above 75% for both companies. Dividend growth rate might not be very high, but both companies consistently grow their dividends. It is fair to assume that dividends will continue to increase in the foreseeable future. Before revealing which stock finds a way into my portfolio, let us know below in the comments which company you have in your portfolio. Comparing both companies against 14 key metrics, there is no real separation between which company is better over the other. Exxon is superior to Chevron in 9 of the metrics compared to Chevron's 5, but no real differences exist between the two companies. For example, Chevron has higher revenue and dividend growth for a 5-year period, but Exxon has a superior EPS growth rate and stronger cash position. The final decision comes to personal preference, and my own preference is Exxon. Zacks rank supports this decision as Exxon carries a Zacks rank of 2, which means buy, while Chevron has a current Zacks rating of 3, which is translated to hold for the time. Please note that this is not a financial advice, and you should do your own research before investing. Hopefully you enjoyed this video. If you did, please hit that like button and subscribe so you don't miss upcoming videos.